Hi everyone. We're going to take a look at how we measure and report receivables. There are two basic types of receivables. Account receivable, which is typically only evidenced by an invoice, and then we have notes receivable, which is a formal promise to pay a specified amount in the future, and including interest typically, or what we call interest-bearing notes. Accounts receivable are almost always trade receivables between the company and our credit customers, but there could be non-trade short-term accounts receivable, and those would be the result of a transaction not involving customers. So typically, if you see accounts receivable, it means that it's also a trade receivable. Almost always that is the case. Then remember that we have to classify receivables as either being current or non-current assets. So if we have a receivable that will not be collected, a note, for example, that will not be collected for 2 or 3 years, that would be listed as a non-current asset. Let's take a look at the accounting for bad debts. When a company sells on credit, there's going to be some credit customers that default on those obligations, which means that we will not receive our cash, even though we provided goods or services. The accounts receivable account is what we call a control account in the general ledger. We also have an accounts receivable subsidiary ledger, and this subsidiary ledger is comprised of all the individual customer accounts. So at any given point in time, if you add up all the balances in the subsidiary accounts, it should equal the debit balance in the accounts receivable account, which is the control account in the general ledger. When we account for bad debts, we have to use the matching rule or matching principle, which says we should recognize the bad debts expense in the same accounting period as when the receivable or credit sale was generated. Well, the problem with that is we sometimes can't determine which accounts won't be collected for a year or more. It could be 2 or 3 years. And so in order to fulfill this matching rule, we use what is called the allowance method, and that makes us base our bad debts expense on estimates made at the end of the accounting period. So at the end of the accounting period, we're going to do an adjusting entry for an estimated bad debt expense, and then when actual customer accounts are adjudicated to be uncollectible, we would have to write off those specific accounts. So how does a company come up with an estimate of bad debts? Well, there are two basic ways. We're going to see that the estimate for bad debts expense can either be estimated under what we call the percentage of credit sales method or the aging of accounts receivable. But for right now, they're just going to show you what the journal entry would be to actually record the adjustment at the end of the year. At the end of the year, regardless of how this amount is determined, we would have a debit to bad debts expense and a credit to a contra asset called the allowance for doubtful accounts. When you increase an expense, you're going to make retained earnings under stockholders' equity come down. When you increase a contra asset, in effect, it's going to make total assets come down. So that's the adjustment at the end of the year, and this amount that you're seeing in the journal entry would be the result of an estimate under the allowance method. When we write off specific accounts, the journal entry would be a debit to the allowance for doubtful accounts, which would make a contra asset go down and total assets go up. The credit would be to accounts receivable, which makes total assets go down. So look at the interesting result. When we actually write off a customer account, it has no effect really on the balance sheet and absolutely no effect on the income statement. So the allowance for doubtful account causes total assets to increase when we decrease the contra asset, and the credit to accounts receivable makes total assets go down. So it's a wash. So when do we affect the financial statements? The only effect is when we make an estimate of bad debts and do an adjusting entry at the end of the accounting year, not when we write off specific accounts. When we do the adjustment, we cause an expense to go up, which will flow back as a decrease on the balance sheet under retained earnings. And on the balance sheet, we make a contra asset go up, which makes total assets go down. Let's take a look at what happens if we recover a bad debt that was previously written off. What we would have to do is a two-step process. We would exactly reverse the write-off that we did. So we would reestablish the accounts receivable with a debit, causing the asset to go up, and increase the allowance for doubtful accounts. So notice that these two offset. Again, there is no effect when you reverse the write-off. Then, because we received cash, we would then debit cash and remove the accounts receivable. So your first question might be, well, why did we debit accounts receivable here and then take it off here? Why didn't we just debit cash and credit the allowance for doubtful accounts? It's called an audit trail. Companies want to be able to see that what happened is it wasn't cash, coming in from a credit sale. We first reestablished the receivable back on the books and in the customer's account, and then show the collection of the cash. So it's strictly for audit purposes to create documentation of how that cash came in. This is a great sort of summary here. When we record the estimate of bad debts expense in the adjusting entry at the end of the year, it makes an expense go up and a contra asset go up, which makes net income go down and therefore flows back to the balance sheet as a reduction in retained earnings. The asset is decreased because when we increase a contra asset, it makes the net accounts receivable go down. When we write off a specific account, we reduce the accounts receivable and reduce the allowance for doubtful account, which is a contra. So there is absolutely no effect, because when you reduce accounts receivable, assets go down. But when you reduce the allowance for doubtful accounts, assets go up. So therefore, there is no effect on either the balance sheet or the income statement. So what they're going to show you next is how do we come up with the estimate for bad debts expense. Let's come down here, estimating bad debts expense. So remember, this is the adjusting entry at the end of the year. The percentage of credit sales method takes a historical percentage of what were uncollectible credit sales in previous accounting periods, and they take that historical bad debt loss, multiply times the credit sales for the current period to get bad debts expense estimate. This is called an income statement approach because we use credit sales, which is revenue, to estimate an expense. The adjusting journal entry would record a debit to bad debts expense for $15,000 and a credit to the allowance for doubtful accounts for $15,000. So let's take a look at the allowance account. At the beginning of the year, we had a balance of $25,068. During the year, we wrote off $17,068. So if you take the $17,068 and deduct it from the $25,068 beginning balance, there would be an $8,000 credit balance remaining prior to adjustment at the end of 2014. When we calculate the estimated bad debts expense, we're going to debit bad debts expense and credit the allowance account to increase the contra asset. So when we credit for $15,000, there's already a remaining credit balance of $8,000, so we would end up with an ending balance in the allowance account of $23,000. What's going to happen is that $23,000 would then be deducted from the accounts receivable balance to be reported on the balance sheet as accounts receivable net. And they show you that up here. So let's take a look at the second method. The second method is called the aging of accounts receivable. The percentage of credit sales method is considered to be a much easier method, but the aging of accounts receivable focuses on specific accounts and how old they are since the credit sale occurred. We know that the older an accounts receivable is, the less likely that it will be collected. So down here, they give you an example of a very tiny, simple, what we call aging schedule. And what it does is it takes all of the outstanding invoices that are still sitting uncollected in accounts receivable, and it drops it into what we call age classes. So 115,000 of our accounts receivable are not yet due. So if we offer credit terms of 30 days, that means that these sales occurred within the last 30 days. And notice that the estimated percentage of the accounts not yet due that will be uncollectible is only 2%. So 2% of 115,000 gives me 2,300. Then, if it is up to 90 days past due, that means it's as old as 120 days. Notice that the percentage goes up as the age of the receivable goes up. So 69,000 times 10% is 6,900. Over 90 days past due is 46,000. That age class is estimated that 30% of the receivables will not be collected, and that equals 13,800. When we add up the dollar amounts from the three age classes, we get an estimate of 23,000. Here's the key. This estimate is not necessarily equal to bad debts expense. Instead, it is the estimated ending balance in the allowance for doubtful accounts, what we want to end up with here after we do the adjustment. Now, it just so happens that the numbers equal in this problem, which is not very realistic. So what I did is I created a document that shows both a sample problem using the two methods and the solutions. And there is a link under your Chapter 6 module in your Canvas page. So you may want to look at that example, okay, so you can see the differences in the two methods. But anyway, what we would do is we would take that estimate, we would make that the ending balance after adjustment, and then we would take the beginning balance minus what we wrote off. That gives us that 8,000 remaining credit balance before adjustment. Then the 8,000 would be compared to the 23,000 to determine that we would have to credit the account by 15,000 in order to bring the allowance account up to 23,000. So again, the journal entry would be a debit to bad debts expense for 15,000 and a credit to the allowance for doubtful accounts for 15,000. Don't get confused by the fact that the amount of the adjustment is the same, because typically in the real world they would not be. Okay, so hopefully you would use my example and see that the numbers can come out slightly different. Okay, that's it.